We're digging into the archives for this case study to talk about an interesting situation from back in 2015. So this one's an NPL JR that was paid. In other words, a non-performing loan in junior lien position that was paid through a full payoff. Now let's look a little further and find that our collateral in this case was a condo. We were behind a current first position loan and there was full equity coverage. And we know that because the value of the condo was $220,000. The senior lien was owed $152,000. So that leaves us about $68,000 of equity. More precisely here, the value minus the UPB equals $67,538, and our principal balance owed, the UPB, was $20,238.06. Now, to calculate the equity coverage here, we take that equity figure divided by our principal balance. And since it's greater than 1 at 3.337, we know that we have full coverage in the deal, but it does not consider the borrower's perspective. Looking at the CLTV, or the first lien plus the second lien divided by the fair market value, we can see that that is also full coverage because it is less than 1 at 78.52%. So we know the borrower has some skin in the game here, and with a CLTV of less than 80% in this case, we've pretty high confidence that this borrower is going to pay off or come to some arrangement on the loan. Looking a little further here at the cost basis, you can see back in the good old days of 2015, you could pick up a non-performing second lien behind a current first with full equity for just 20 cents on the dollar. So just $4,048 to buy $20,000 of principal balance, and then resolving this case with a payoff of $21,759.68 when you include some of the interest that was owed on that deal in the full payoff. So this one, as I mentioned before, is an interesting situation. And the story behind this deal is actually that it was sold. This deal was sold to an investor as part of the pre-sale process that we were running back in 2015. This was early days with my client, US Mortgage Resolution. And when we were financing a portfolio of loans that we were purchasing from the bank, we were pre-selling some of those loans to trusted investors to raise some of the capital for the deal. Well, this loan was sold on September 29th, but we got notice from the bank that it was paid off September 28th, literally the day before. And at first, the investor who purchased this loan was very excited. They actually called me up and said, we talked to the title company and this deal was paid off on the 29th. And I said, well, great, the money is yours. The cutoff date on our contract specifies that the date you wire the funds to buy the loans effectively become yours. Any money that comes in on the day of or after your cutoff date, the day you wire the funds to buy the loans, those are your proceeds. But because the timing was so tight and I was relatively new, I was 4 years into the business at that point, I talked to the principals of US Mortgage Resolution and they advised, hey, let's just double check the timing on this. And we got some more information. And like I said, the deal was paid off on the 28th, the day before the cutoff date from that note investor. So unfortunately, it was my responsibility to reach out to that note buyer and say, that deal we thought we were paying you off on, we actually just have to refund you your purchase proceeds, and that money belongs to us because it happened prior to the cutoff date on your contract. So it was very unfortunate for their perspective, but pretty awesome from ours. And you'll see the potential IRR on this, or internal rate of return, was huge. So the back of the envelope calculation for IRR, we take the total amount collected minus the cost basis divided by the cost basis, or in other words, your return on investment. But then we annualize that by putting in the denominator of this calculation the months to exit divided by 12. Now, if we take that $21,759 payoff minus the $4,084 we paid divided by 4,084, we get a 432.8% ROI. That means that our internal rate of return, if that deal took 1 year, would have been 432%. But because it only took a quarter of a year from the point when we closed the deal to the point where that payoff came through in the interim servicing period, it was actually 0.25. It was a quarter of a year in the denominator, which means that our internal rate of return was 1,731%. Like I said, the good old days in 2015. Now, the good old days are still here when you can find motivated sellers to find great deals. And that's a major takeaway on this particular deal. What we had in this arrangement going into 2015-16 when we were pre-selling some assets was working with trusted counterparties to fund portions of the loans we were buying from the bank. And if you can find counterparties who have relationships with motivated sellers and you can partner with them on deal flow, that creates a great opportunity still today in 2023 going into 2024 to find great non-performing loan deal flow. Another takeaway here is to check out our course, Find, Fund, Flip. You can pay for it with just $1. It's our first a la carte course that's available outside of the Mortgage Note Mastermind group that teaches you exactly how to find motivated sellers who have great opportunities to buy non-performing loans just like this. So go to fixnotes.com/find-fund-flip and you can pay just $1. It's a pay what you want course that you can get access to in FIXnotes' ongoing mission to democratize the secondary mortgage market. If you have any questions at all about this deal, comment below and I'll reach out to the buyer who was originally going to purchase this deal back in 2015 and see what they have to say maybe in the comments below. By the way, they're a member of the Mortgage Note Mastermind membership. Now, years later, we've been working together for almost a decade. Even when we've got deals like this that went sour, so to speak, they're still a trusted member of our Mortgage Note Mastermind and we continue to do business together, non-performing loan sales like this to this day. So leave a comment below and we'll talk soon.